All right, let's talk a bit about yields. They're sitting at more than 1-month highs. That's yields on what you get investing in treasuries and the like. Let's bring in senior markets commentator Mike Santoli. Of course, yields do figure prominently into our views of the stock market. Mike, what do you make of this move lately?
10-year, 2-year, they've kind of risen to check back to where we were in mid-December, basically at the last Fed meeting. And past couple of days, you've gotten a little bit of a test on this idea. Is good economic news good for the markets? If you believe yesterday's retail sales number, that was kind of blockbuster, had GDP estimates going up for the fourth quarter today, really low weekly jobless claims. Do we extrapolate from that? Do we believe it's a real number? Is that the economy we have right now? So that's where the market, I think, is trying to sort out. I don't think that we necessarily are going on the assumption we have a 5% nominal GDP economy, which is what we had coming into this year, if you believe the GDP, because if that's the case, Fed maybe doesn't have to do anything in March. So I think we're going back and forth on all of these things. At the same time, I think the entry point was so crucial for this year, which is super overbought market. We went straight up. And what the market does when it gets stretched is it goes hunting for the clustering of crowded consensus opinion. And one was the broadening of the markets. Two was the March rate cut, and maybe a series of them from there. And so I think it's really kind of a normal process, this kind of predictable, necessary, and probably ongoing correction. Half the S&P is more than 10% from its high. The S&P index itself, down 2%. So not much damage at the index level. I just wonder whether, you're going to be able to get rescued by Taiwan Semi and Apple as we move on from here.
Mike, in the last hour, we referenced this Wall Street Journal story. Yeah. Not one we're unaccustomed to seeing. $8.8 trillion in money markets. If rates move down significantly, are people going to be forced to look for returns in the stock market again? But give me some historical perspective on this.
I just dislike this entire line of logic around, well, there's this massive pile of cash, which in nominal terms seems enormous, and it is. But I went back and looked at that chart, and I said in early 2015, you were at $4.7 trillion in time deposits and money markets. That was a bigger percentage of equity market cap then than this is right now at 8.8. We have a $45 trillion stock market. A lot of that cash, Leslie, the money market stuff is just deposits that migrated there. And it's not money that's about to go into the stock market. But I think the key is the more time you spend figuring out which discrete dollar is destined to go into stocks, is it buybacks, is it money market funds, is it just cash on the sidelines argument, the less, I think, useful it gets, because you don't have to worry about it. If the economy holds together, if earnings come through, people let equity exposures go up, they don't sell their stocks as readily, and the market does fine. You don't have to kind of account on the ledger for where the dollars are coming from.
Right. Yeah, you've never liked that discussion.
It's a tough one.
Although B of A today, Savita puts the cash at households at $18 trillion.
Yes. And I
a lot
think
more
you
than
could say that that's a buffer for consumption, and it shows you that in aggregate the household sector is in good shape. But to me, it doesn't mean X number of those dollars have to go into equity funds in order to kind of meet my S&P target. I don't think that's what she's saying.
Is there also some kind of psychological component, too, given just the incredible rise we saw in the stock markets last year? If you're talking about household cash, if you're talking about, money that's in CDs, difficult to get out, perhaps, maybe they're less inclined to do it, to put it into the stock market this year, just psychologically, given how much it rose last year when we're talking about just overall asset allocation.
Well, I would say psychologically, but also if you were already in the equity market at all, the market raised your exposure to stocks, because it went up in value. And so the whole rebalancing effect is, like, if I just look at the equity allocation among households, it's not low. It's not like, oh, people aren't in this market. No, they're above historical norms in terms of their exposure to stocks. So I don't know. I just feel like that's a little bit of a kind of circular parlor game.
Mike, thanks.
Okay.
We'll talk in a little bit. Mike Santoli. Let's dive a bit deeper into the markets with Charles Schwab Chief Investment Strategist Lizanne Sonders. Lizanne, I hope you won't mind me dragging you into that discussion about sideline cash and whether or not you think it's important, at least this year, next year, on an index level.
I 100% agree with everything that Mike said. I think that is stickier money in the sense that it's come from more traditional deposits and or maybe even places where investors had gone in the low rate environment to pick up yield. Now they can do it in the safety of something like money markets. The percent of total market cap is fairly low relative to history. And it's also the case, and I don't think Mike mentioned this, that if you want to find reasons to be bullish on the equity market, it doesn't necessitate a move of some or even any of that money going from money markets into the equity market. For much of the 1990s, you had a simultaneous move up in money market assets and the equity market. So I agree that I disagree with people who are putting a tremendous amount of weight on that as sort of a prospective reason to be optimistic about the market. I think the market can do well, but not necessarily because that money has to shift gears and move into equities.
Right. That's pretty interesting. Interesting also that the Journal gave it so much play today. As for yields, Lizanne, how much are you on guard to see if at least the 10-year dives deeper into the fours and starts to challenge our assumptions about not just the pace of Fed cuts, if there are any, but the pace of inflation as well?
Well, I think yields are still in the driver's seat. I don't think we break that relationship, at least in the near term. And by near term, that probably carries through to at least the March meeting when we actually see what the Fed does. And in particular, since the midpoint of last year, that connectivity has been extraordinary with the move up in the case of the 10-year from sub 4 to 5%, directly corresponding to the correction from late July to late October in the S&P, a slightly bigger correction in the NASDAQ. And then you had the flip back and the boomerang in yields from 5 back down to sub 4. That gave not only a lift to the overall market, but really was fuel for small caps because of that greater sensitivity to moves in yields. And a lot of people are thinking about the calendar year turn as some reason why the market has struggled a little bit. I don't think that's it. It's just coincidentally, maybe you saw the bottom in yields occur right at the end of December. December 28th, I think, was the date for the 10-year. And sure enough, you've seen choppier action in the cap-weighted indexes or the larger cap indexes and much weaker performance in the small caps. And I think that tight inverse correlation between bond yields and stock prices is sort of the story, at least near term, and will continue to be.
Yeah, continuing from 2023. Tomorrow will mark actually a week of fourth quarter earnings season, which, speaking of choppiness, it's been kind of a noisy quarter out of the gate. Do you expect the rest of the fourth quarter earnings season to be kind of more of the same? We've seen some downward revisions, some mixed picture in terms of analyst notes and so forth.
Yeah, I think the downward revisions have been pretty notable. Right now, what they call the blended growth rate, which is the still fairly low percentage of stocks or companies that have reported. It's their actual results blended with the consensus for the remaining of companies. And that's obviously going to change on a day-to-day basis as we get more actual reports in. But that's down just a little over 4% right now. The expectation just as recently as October for Q4 earnings was 11%. So that's a pretty decent haircut. And you've seen not just the haircut for the quarter that we're currently reporting, but all 4 quarters in 2024 have been haircut down. Now, what ultimately may happen is analysts during earnings season cut so much that the bar ends up low enough that you get better than average beat rate, better than average percent by which companies beat. But I think it's that broader trend of we were probably a bit too optimistic heading into the end of the year and almost certainly too optimistic for calendar year 2024. So I think there's probably still more downside to go to sort of level set 2024 earnings to the macro backdrop.
Hey, finally, Lizanne, on AI, obviously the discussion surrounding it is driving some chip demand. A lot of the chip names at some new highs today. It's getting discussed in Davos. It's being used by some corporates as a reason to either lose headcount through attrition or through outright layoffs. I wonder if you think the impact of AI is coming into fuller view in these early few weeks of the year.
Not only do I think it's coming into fuller view, and maybe rightly so, I think the focus this year is just as much on the users of AI across the spectrum of sectors and industries, where I think last year was more a story of the creators, which companies sat behind the engines of AI. Now I think, and you're seeing it in earnings season, where you can't get through a conference call without analysts, if it wasn't already mentioned by company management, how they're thinking about AI, how they're bringing it into the mix, whether it's for margin protection or long-term productivity or efficiency. And I think that will continue to be more of the story this year, is the utilization of AI, again, across the spectrum of sectors and industries.
It's pretty interesting to watch the markets try to price that in as best it can. Lizanne, talk soon. Thanks so much. Good to see you.
Good to see you.
Lizanne Sonders.
As we head to break.